Good morning, ladies and gentlemen. Welcome once more on this great Thursday morning. Karibuni sana, welcome to yet another session on phase 2 of the DTB personal financial literacy training. We are almost quite halfway through the modules for this particular month into November. So karibuni sana, ladies and gentlemen. Today is module 3. And good morning, Rogers. We see you. Thank you for always keeping time, our dear participants. Karibuni sana. Today we will be covering module 3 on equities, collective investment schemes, and real estate. This is part 2 of what we began last week, which was introduction to investments and fixed income investments. And module 1 was on debt management strategies. So thank you so much, ladies and gentlemen. As you join in, as always, we'd love to know your key takeaway from last week's sessions. And so far, whether it was in phase 1 or phase 2, any new changes you have made. You can also raise your hand. We would love to hear your voices and to get feedback on how the training is going for you. What have been the aha moments or the moments where you feel, okay, maybe the areas I need to change. So thank you so much for joining in. Like we said, we're on module 3, equities, collective investment schemes, and real estate. And we thank you so much for all the questions and the engagement that you've been having so far, and for your commitment to growing your personal finances. Good morning, everyone. We can see you. Joyce Nairobi. We can see you. Good morning. Welcome all, ladies and gentlemen. We have Faith and Victor, who will be our sign language interpreters today. I will also write the same on chat. And Elizabeth, you are all familiar with Elizabeth by now. I'm our expert when it comes to matters personal finances and investments, and she will be taking us through the session today. Yeah, so without much further ado, let me welcome Elizabeth so that we can make the most of the session. Karibu sana, Elizabeth. I think you can just check on the sound. I think we might. All right, okay, we have a bit of a connection issue. But as she joins in, like I said, you can raise your hand and we'd love to hear from you. As always, what you're changing and what is something that you're looking forward to, even in today's session. Yeah, and just maybe also a little bit of housekeeping. We do share the recordings and the slides the day after. So as long as you've been able to join, you will receive recordings and slides from the previous sessions. And we are seeing the engagement or the viewership on the recording. So that is also encouraging to see guys going back to make sure that they make the most out of the sessions. And then certification, we will have a threshold of at least 3, attendance of at least 3 out of the 5 modules. And usually we look at the minimum 30 minutes of attendance. But we really encourage to hire, because the aim at the end of the day is that you're able to change or level up your personal financial management game. So we see Elizabeth has joined once more. Thank you. Yeah, over to you. Elizabeth, please confirm you can hear me. All right. I think we have a bit of a connection issue. We just request for your patience, team. As I think Elizabeth said, sorts out the connection issue. So let's just give her a few minutes, even as we have the rest of the team members joining in. Yeah, Stephanie, I've seen your question. I hope now you're clear on certification.
No, so one hand comes the C like this, then this other one.
All right, thank you team for your patience. Elizabeth, please confirm that you can hear us now.
Yes, Manchu, can you hear me? Can you hear me?
Yes, I think now we can hear. There was, I think, a bit of a connection issue even on the screen. So maybe you could remove video so that it can enhance the connection. Liz, maybe you can confirm that you can hear us. Right. Okay. We're having a bit of a challenge there. Augustine, thank you. Good to have you. Good to have you back. All right. Thank you, team, for your patience. We just request for a little bit more patience. Sometimes technology can decide to take charge and teach us. All right. Thank you, Lucille, for understanding. Okay. Yes, Harriet, let me just engage with her offline and see how we can help her. All right, so as we wait for her to join, one other thing we've seen in the training is that peer learnings are a key thing. So I've just asked in the chat, please let us know your key takeaways so far. I can see we have Walter, your hand is up. I don't know if you're able to unmute and speak. And as Walter speaks, Brian, you can confirm that you're online. Okay, Walter said he will speak later on. All right, thank you. All right, please, I can see you're on. Maybe I can help sharing the presentation. Please, I think now, yeah, we can hear you. So you can unmute and I can support with the presentation. We have Jane joining us for the first time. Karibu sana, Jane. We have Shemina who's saying she's learned how to reduce debt and invest for the future. Yeah, and it's been interesting to see how the two are actually aligned, that once you have your debt management game on check, you're now able to focus on the investment side. things. Thank you for that. Vedis, you remember? Yes. Thank you, team. Yeah, you can use this free time to get maybe some bit of tea and coffee before the session.
Manchi, maybe you can just make the presentation for me. I just
Okay,
project the presentation. I've just
all right. Please confirm that you can see.
Yes, thank you.
Okay,
Thank you.
good.
I've just changed devices. I think my device had a problem. Thank you so much.
All right.
So maybe we could just start. Thank you, Mantui, and sincere apologies for the technical issues. Today we are going to discuss three key things. So it is going to be a crash program on three things, that is equities investments, collective investment schemes, and real estate. If you have been with us over the last 2 weeks, we went through debt management that Brian took us through. Last week, we looked at fixed income and how you can use that for growing your wealth. So today, we are going to look at what is equities, what is collective investment scheme, and how to invest in real estate. So we could start with equities investments, a quick one. And Mantu, you could go to the next slide. So maybe for people who are on call, when you hear the word equities, what comes to your mind in terms of maybe an example or even just the definition? What comes to your mind when you hear the word equities? Investments, I'm just trying to see on the chart. So when you hear equities, shareholding stake, thank you so much. Yes, it's really just a unit of ownership in a company. Remember, when you start a company, you put in money in two ways. You can put money in form of equity, so you are the final owner of all the money that comes in, or alternatively, you can actually pay yourself dividends and all that. So you own the company, and this comes in whether it is listed or non-listed. So you are a shareholder. So that's one way of financing a company. The other one is through debt. That is the other way, but there could be structures in between, which are called hybrid solutions, whereby some of them would you own the company, but you have preferential income. That is called preference shares, and all that can also be converted. You can actually start off as a debt holder, and then you convert to shares. So today we are going to be looking at shareholding on a unit of ownership. Where do these shares trade? So shares can actually be listed or unlisted. If they are listed, then they trade in a stock exchange. Stock exchanges are trading platforms that are regulated by the Capital Markets Authority. And for you to be able to trade those shares, then they need to be held somewhere. And the holding account is called a CDS account. A CDS account is actually controlled by an institution called CDSC. So they hold all the shares. So a while back, you would used to get a share certificate. You no longer get a share certificate for companies that are listed in the exchange. What you have is an account showing how much you hold and how much you own. Then for you to be able to trade, you need either an agent, or who trades through a stockbroker. A stockbroker is someone who is regulated by the Capital Markets Authority. As we speak, there are a couple of them. Maybe people like Diane Blair, we have brokers and are able to trade on it. What we are actually now seeing more and more is that there is a lot of demobilization, and actually the share is that you can actually now be able to trade even on open CDS account and trade using your mobile phone. However, you still have to open an CDS account through a broker. Then the way companies get listed or start trading in the market is called the initial public offer. That is the first time a company goes into listing. I think most of us would have heard about the Kenya Pipeline Corporation. There's a lot of conversation about it, that right now they are working on getting their them listed on the securities exchange. So that's where we are going to see a new a new company coming. The last ones that we saw were maybe like Kengen and Safaricom. Those are the first ones that came to the market. So the total amount that is listed in the market, the stock exchange, is called the market capitalization. This is the value of all the shares, and it's really just looking at the number of shares plus the price that they are trading at. Then how do you get your return? And here my audio is off. That's so. Can you hear me? Yeah, okay, fine. I think you can hear. So how you get your money back is either through dividends or you sell the company. You sell the company that you currently hold, or you actually get dividends, and we shall be looking at how we decide. And I'm unable to see the thread and the thread is my screen. Wow. So in terms of how you get your money, you either get money through buying low and selling high, or alternatively, you can actually get what is called a dividend. There are companies that have better dividends than others, and we shall be able to take you through where you can be able to see that. Must there are people who are saying they can't see the slide. I don't know what would be the technical issue with that.
All right. Can the slides be seen now? And then also seeing, I think there's a bit of an echo on the audio. In the beginning it was okay, but I think now there's a bit of an echo. Team, please confirm that you can see the slides. Okay, so the slides are visible, but there's an echo.
So I think we can continue.
Yeah, I think that's better.
You can see the slides, right?
Yeah. And then maybe also the other recommendation is that we can remove video so that sound can be a bit more, yeah.
Okay. Sure. So this is much better. I believe so. So we can go to the next slide. So how then do you determine how much you are worth? There are a couple of things that you look at. I want us to stop looking at this. We go straight first of all, and then we can come back to this. There is an issue with the audio now. There is an issue with the audio. Manchu, can you hear me?
Yes, we can. We had lost you a bit, but now we can hear you.
How do I cancel this? Manchu, you can go to the next slide. So I would like us to just give context in terms of the various kind of investors who come to the stock market, and I will do that by just giving some examples here. There is some of us who invest and are relatively impatient. So I'll give an example of Kevin. Please, no offense to the names that I'm using. I'm just using them for the sake of context. So for Kevin, jumps into the stock after hearing news or tips. So they're always looking for tips, and then they buy. So they bought Safaricom at the price of 35 during the peak. And then when they saw the share price come down, they sold it at 24. That makes them they were losing. Then there is Mercy, the believer. So bought shares of Equity Bank because she believes in financial inclusion and believes the story of Equity Bank. They have constantly ignored the market noise, and they consistently now are holding on to the shares. So don't panic even when price drops temporarily. Then there is David, the curious beginner. So since they use M-Pesa on a day-to-day basis invest in Safaricom because they have done the analysis and seen that for as long as they are able to use Safaricom, they will be able to get income from them. So they have analyzed the stock market trends, and then they can actually say that, okay, fine, I can keep it on and continue with this. Then there is Alice, the overconfident trader who is constantly buys and sells stocks weekly based on the tips that they are getting. So gets excited by sudden gains, but loses more on the long run. So we will want, one of the things that we'll actually see is the cost of trading, because that also takes away your returns. So you need to make sure that what you're looking at is the returns in totality. Then we have the Stella, the dividend queen. So what happens is that this particular person is always looking at the dividend and trying to see what is the best company that is giving what kind of dividends. Remember, dividend, we said, is the distribution of income on an ongoing basis. So maybe it's for us to take a pause and say, if I have been trading, how do I trade? Am I that person who is always listening to tips and constantly actively trading? And what does that do to us? So Mantwi, the next slide. So when it comes to the key, what are the key things that we look at when we're investing, or what are the strategies and what are the key outcomes that you'll get? You'll actually notice that the curious beginner will start by investing very little amount of money, and that grows over time. What do you see with that particular person? They are able to grow their portfolio, and the beauty is, over time, you will see that the stock market continues to do very well, and so their portfolio grows. Then we have the impatient chaser. One of the challenges that with the impatient chaser is that this person is relatively well knowledgeable. However, the biggest problem that that person ends up having is that they lose money because as they trade, they're actually losing money to the trading cost. So I'll give you an example. Every time you trade, you actually you're actually costing about almost 2.5% of your total capital, and that is upfront, as you sell a similar amount of the amount that you have made. So you can actually see if you're constantly chasing and selling, it means that you will be losing the income that you, or the returns that you are really looking for. Then there is the person who is the dividend queen. This person buys and waits for the dividend to come in. So they are able to actually plan their life around that. So for example, if you take companies like BAT and Stanchart, their dividend yields is anything above 15%. What is a dividend yield? It is, you look at the share, how much you're getting paid, and then you divide by the price. Those dividend yields have been relatively high for some stocks. For some stocks, they don't pay a lot of dividend. They believe that if they have growth opportunities, they will actually continue to invest in that amount of money. Then there is the overconfident trader. Again, this is the person who is constantly believing that they can make a good bet compared to everybody else. Where do we need to be? I think if you look at where you start, if you're starting right now, just be relatively curious and continue to grow your portfolio over time. If you're trying to invest for a very specific need that can be that you can get through dividends, so the same way that you were talking about coupons last week, you can actually look at the companies that have a good dividend yield. And where can you be able to get this information? The information is readily available in the newspapers, especially the Business Daily. So Mantu, we can go to the next one. So what are some of the things that you need to understand when you're thinking about equity? So maybe the key thing is we have talked about shares. Those are the units of ownership. You become a shareholder and you're entitled to receive what is called an annual report. From the annual report, you would be able to understand the growth where the company is going, and you'll be able to make your own interpretation in terms of how that is. Is it something like a retail investor can do? The answer is yes. But at times, it might make sense for us to understand what to buy by just reading research reports from some of the brokerage houses or some of the fund managers. So what is the key stock investment cycle? One is you purchase the share. So how do you purchase the shares? You open an account through a stockbroker. That is the CDSC account, and then you actually put money there. Most of the shares trade T+3, meaning that if I buy a share today, it will settle 3 days into my CDS account. Then I become a shareholder. Once you become a shareholder, you participate in the profit. How do you participate in the profit? You actually get the dividend, or the share price goes up and you're able to sell it at a higher price. So you are part of the people who are going to contribute to growth, and the management is answerable to you. So I'll give you an example. If you're a significant shareholder in a certain company, we all remember maybe the conversation that was going on when Ginjoro was talking about KPLC, is that once you become a significant shareholder, you will actually be able to ask the right questions. So that is one of the benefits of being a shareholder. You'll be able to ask management and ask them, and they are answerable to you when it comes to that investment. So that is basically the ownership cycle. I want us to just look quickly. What are the three types of shares? So I have talked about them before. They are listed shares. These shares trade in an organized exchange. So when you talk about Safaricom, when you talk about equity, when you talk about DTB, all those shares you can actually go to a stockbroker and buy, and you become a part owner. There are others that are not fully listed. They trade in what is called an unquoted exchange. Shares like Family Bank and some shares like what we call Fungo Investments. Those ones are not fully listed, but you can still trade them through some brokers. Then there is what we call private equity. So for example, I would like to invest in Java, for example, and I'm using Java because it has gone through a couple of private equity purchases. So these shares you are investing in a company that is not really tradable, or you are starting your own business. That would also be looked at as a private equity investment. And then finally, there is what is called preference shares. For preference shares, it is something in between debt and equity. So the owners here get priority in terms of dividends and distribution of anything that comes to the organization. How they are ranked higher than the listed shares or ordinary shares, and you have a minimum, the minimum investments the minimum returns that you will get. However, if a company does very well, you will not be able to participate in the eventual performance of that organization. So preference shares, you get a little bit of insurance on it, but again, the returns are not that high. But is there somewhere that at the moment you will be able to buy a preference share? The answer is no. So if today, for example, I wanted to buy any of the stock market or any of the shares, I would go for the listed shares. That is what is readily available. And I will go through a broker. So there's a question, where do we get the stockbrokers? Can we go a bit slower on the process of purchasing shares? So thank you, Anne. So there are a couple of listed stockbrokers that are already licensed by the Capital Markets Authority. So if you go to the website of CMA, www.cma.com, Capital Markets Authority, you'll be able to get a list of all the investment banks and all the stockbrokers that you would be able to trade with. Again, it's something that we can actually share and just tell you these are some of the ones that you can work with. I think Safaricom is in the process of actually being able to help us trade on easily through our phones. Then can I please get a hint on where Old Mutual falls? So Old Mutual is a fund manager. They used to have a stockbroking arm, and they sold it. I don't know whether they have rebranded. I need to figure that out. So we'll be able to answer whether they have rebranded, but they used to have a stockbroker. But as it is right now, they are a fund manager and an insurance company. So we can proceed. So I'm being told to go slightly slower. Yes, I will go slightly slower. So the first question is, why do companies sell shares? The biggest answer is that we want more capital at times. And since we want more capital, that's some of the reasons why we sell shares. So one of them is it helps with founder exit. So that is why we have an IPO or a rights issue. So the owner is just saying, please come and just increase. Let's do this together. The other one is raise capital. And when you speak about the MSMEs, you will actually see that there is what is called a VUCA platform in the NST. They are yet to get a lot of companies going through there, but companies actually go to the market so they can be able to raise shares. The owner wants to sell some equity so that they can be able to get money to run the organization. Then the other one is also helps with public trust, improve public trust, because it increases credibility. By the time you are listed, there is more oversight from the Capital Markets Authority. and even the analysts themselves. So it helps with the public trust, it helps with marketing, which is also good for organization. Then the other one is really attract strategic investors. Let's say, for example, you are talking about companies that would like people in a certain industry. So it might make sense that if, for example, let's say, for example, I am in the energy sector, there is someone who is better in the energy sector, and so they would come and actually be able to take off some of my investments. I think that happens especially in the cement industry, where we saw, I think, Bamburi being bought out by a strategic investor. Then the other one is reduced debt, because remember, as you are doing debt, you have some obligation that you have to pay. So for you to be able to smoothen your cash flows, then it might make sense to raise debt, to raise equity, so that you have more people and you have more capital that can be put there. Then finally, it's comply with regulations. And that's what maybe we are going through when it comes to a lot of privatizations coming in, so that you're bringing in more new people. I'll give you an example. If you're running some of the organization, like even like a stockbroker or a fund manager, there is a minimum number of people that must, minimum number of shareholders that you must have. So irrespective of the fact that you have the shareholding, you might require that someone else comes in so that you are compliant. So these are some of the reasons that people issue shares. Even when it comes to maybe just having local shareholding in some of the sectors, that is why people would have to have partnerships in the local market for them to be able to operate. So there's an example, there being an example of preference shares. I think the only one that is currently in the market in terms of preference shares is actually KPLC, but fully owned by the government. So you cannot be able to trade preference shares at this point in time. So what are the
Liz, I think, all right, I think we've lost Liz. Please confirm that you can hear. Then I'd encourage that we share questions on the Q&A tab, so that it's easier for tracking. If you remember last week, we also agreed that at the end of the session, today's session, we'll compile the list of frequently asked questions, the FAQs, and then try and respond to the ones that haven't been responded to in the chat in today's session. So we do encourage you to send the questions on the Q&A tab. Okay, great.
Thank you, Mantui. Sorry, I think we are back. So the question, so on the market risk, what I was talking about on the market risk, Mantui, the presentation has gone. So on the market risk is something that currently affects the entire economy and affects the performance of the market. So something like the purchasing power of people, if it's not as much, then it affects how the market works. If, for example, there is political noise, all that affects how we view the market. So what are the other risks? Is the business risks. Let's say, for example, something that affects a specific organization, or maybe the projection of what would happen in a company. So that becomes a business risk. Let's say, for example, someone expands into a sector, or a business expands into a sector, and then that doesn't turn out very well. That is a very business risk issue. And analysts usually do what is called sensitivity analysis, so to see what can go wrong in any organization. And if they do that, then you can be able to tell whether to buy the stock or not to buy the stock. The other one is liquidity risk. There are companies that you buy, but you are not able to necessarily get out. So you buy and you want to sell because they don't trade very much, and largely companies that are closely held, like in the agricultural sector. At times you buy and you have to hold on to that share, even if you are not, even if you want to sell. So there are stocks that you can actually be trying to sell for a long time and you're not able to sell. So that is what is called liquidity risk. The other one is really volatility. The markets go up and down. and that affects what you can do. So you need to understand that as you get into the stock market, you could have bought something at 40 shillings, but because of the risk that there is generally inherent in the stock market, the share prices will go up and down. So remember, when you're investing in the stock market, there are no guarantees. You are definitely the shareholder. And what happens to shareholders? You actually can lose your capital. And so that there is no guarantee. But at the same time, it's good to know that there is a lot of growth that comes when you invest in the right stock. On to the next one. And sorry, I know I'm going and I'm responding to the questions as they come. So there's a question, is it wise to invest in an IPO? The answer is yes, you could invest in an IPO. However, you need to do the analysis of the company that you're investing in so that you can actually be able to be investing in the right stock that works for you. So the answer is yes. However, do the analysis, decide why you're going to invest. It's not necessarily a quick win out. It's something that you should be able to wait it on. I'll give an example of what happened with Kengen. Kengen, I think when it was listed, the share price actually tripled on the first day and then came down corrected. What happened in Safaricom? The same thing. People bought into it, but the share price did not triple like Kengen. So there are no guarantees when it comes to investing in the stock market. So what we need to do is do our analysis. And what actually Warren Buffett says is when you buy in the stock market, when you buy a company, you should be ready to stay in it for over 10 years. So if you're not ready to stay in that company for 10 years, then it might not be the right company for you to invest in. Kindly advise on the best stocks to buy in Kenya today. Gladys, please allow me to answer that question conceptually. As we come to the end of that, so that you can actually be able to make the right decision through the process, we shall cover that shortly. So if one has an inactive CDS account, will they still be getting the dividends from the shares they had purchased as they looked forward to making it? Yes, you still remain the shareholder of that company. And when they pay their dividends, you'll always be able to get that. So local cryptocurrency guide on it. So at this particular point, we are not going to cover cryptocurrency. That would be maybe at a different time, but there's a lot of regulations that is coming around the cryptocurrency. So as we do the more advanced private equity, private wealth trainings, we shall actually be able to cover that, Salima. So how then do you determine if a stock is cheap or expensive using relative valuation? So the question is, how do I determine which company to buy? So one of the ways is really to look at compare valuations. You actually look at the prices at which this company traded previously. Was it what was the highs that it went to? What are the lows that it went to? And then you can actually determine through a trend analysis where that is going and how it can be changed. Then the other key question that you can actually look at is actually compare with the market averages. So remember, the companies have been trading over a period of time. If, for example, a company is trading at a price lower than it has traded over the last 5 years, there is a high probability that if the fundamentals of the company have not changed, we expect it to continue trading at a much higher, to trend upwards. The other one is looking at the prices of the same sector. So for example, if I look at DTB and compare that with maybe KCB and maybe housing finance, you look at the prices of those companies, they will be trading at completely different prices. So it is it's not directly easy for you to say that KCB or DTB is trading at a lower price compared to the others. So then what then do you do? You have to come up with a metric that is able to tell you whether a specific company is a good buy or not. Then that is where the ratios come in. You bring something that can be able to help you compare like for like. And what we do as analysts is actually do what is called ratios. That is what we would call like a price to earnings ratio. We are looking at, for each unit of ownership, one share, how much are you paying for it compared to the earnings? So you remember that we own shares, most of us. When DTB responds or reports their earnings, what the whole pot, the profit after tax will be for all the shareholders. So the question is, how much is it for me? So what we do is we look at all the earnings, we divide that by the number of outstanding shares, and then we know what is our earning per share. For each share that I'm owning, how much earnings is that? Then what then I'll try and compare is, how is it trading today in the market? Once I know how much it is trading at today in the market, I can be able to know whether I'm paying expensively or not. So I'll do that for DTB, I'll do that for KCB, I'll do that for all the companies, and then ask myself, which company is trading at a lower price per unit of earnings? That we call price to earnings ratio. The other way that you can actually look at is to say, look at the entire net book value of each of these company. And then we ask ourselves, how much are we paying for that? So for example, if we give it as an example, maybe these are all the furniture that these people have, and how much are we paying for that unit of earnings? So that is called price to book. So what then happens is you look at the sector that you are looking at. So for example, financial sector, and then say, ideally, what would make sense is for us to pay at a price to earnings or a price to book, which is lower. There is another nuance that comes to it. There are companies that grow at a higher rate compared to others. So for as long as the earnings are actually growing significantly, you will expect that you can actually pay slightly more expensive compared to a company that is not growing at that rate. So that is also called a PEG ratio. So all those things are actually available in the business daily. You don't have to do any analysis, and you can actually be able to tell which company to invest in. So that is what we compare within the industry. There are some industry that you'll always have to pay a premium. So at technology companies, you'll always have to pay a premium when it comes to invest, or when it comes to earnings, price to earnings. So just understanding the sector and understanding the specific company, and then knowing where the company is going will help you in terms of understanding what you need to pay for. So that is how you determine which company to invest in. So I think it was someone who was asking which companies to look at. I will be able to project the price lists or the ratios that are there in the stock market, so that we can be able to make that decision towards the end. So I wanted also for us to agree, you see, as you buy and sell shares, it is not done for free. There are costs that come with it. So you need to understand what costs these are. Some of these costs are the brokerage fee. It's usually an average of 1.5%. There is the CMA fee of 0.12%. There is the CDSC fee of 0.08%. There is the NSA levy of 0.12%. And when you sell shares and you are selling them at a profit, there is a capital gains tax of 15% of the price differential. How does that work? So if, for example, I buy a stock at 50 shillings, then it goes up all the way to 50 shillings, to 100 shillings. The extra 50 shillings, I will pay tax on it at 15%. That's what the capital gains tax will work. Now, let's even assume that I have 100,000 shillings that I want to invest in the stock market. The amount of money that I'll be able to invest is net of this fee. So for example, instead of having 100,000 to buy the shares, I will have 97,000 to buy the shares, because I have to pay brokerage fee. So I think we need to understand that. Then when the shares now appreciate, maybe again the 100,000, they double in price at 200 shillings. I will not get 200,000 shillings. What I will get is 200,000 shillings less the brokerage fee of 2.75. So again, what you take home will be maybe 195%. So that is very important. And that's why I was talking about the active trader. For the active trader, you need to make sure that at least your returns are above 5% for you to break even. Yeah. So there's another question. Are there reputable local companies or investment platforms in Kenya that you would recommend for purchasing international shares, such as and Amazon or Apple? Yes. What are they called? I'll give you the EFG actually does that, and they're regulated by the Capital Markets Authority. So yes, Moses, there are a couple of them, and I could actually, we could be able to connect you to some of them. In the current digital world, how can one track the listed shares market from the comfort of their phone? The answer is you could be able to do that. The easiest and the one that I can actually recommend is just being able to log into Business Daily. The beauty is there is a lot of checks and balances to do that. Investment strategies are so we shall be looking at some of the investment strategies and what those are. How do you determine what to invest in? As a client, there are things that you care for and are important to you. So how do you determine what to invest in? One of them, we talked about the dividend strategy. I just want things that actually pay higher dividends. So again, what are the dividend stock? If you look at some of the companies that pay really, really good dividend, would include things like Standard Chartered Bank. So all those, again, you'll be able to check and see which ones pay really, really, really good dividend. There are some companies like BAT whose dividend, they're really a dividend stock. For them, they would rather even borrow so that they can pay dividends. So you actually can be able to say, I'll pay school fees using dividends of the stocks that I have invested in. So that is very easy. The other one is just fundamental analysis, really looking at the company. Where is it going? Is it expanding? How is it going to grow? And you're able to see the ones that are cheap and you buy. There are some that we just invest because we like. Let's say, for example, I like the services I get at DTB. So I will hold DTB because I believe that they're growing. Then what I've talked about, the valuation metrics, if you look at the companies and say, okay, the price to earnings ratio, the return on investment is high, so I will be able to invest in that. Then there is I will invest because these people care about the environment and they are socially responsible. And one of the things I saw is that there's some Australian pension fund whose actually key investment theme is ESG. And then I can actually also look at technical analysis. If Safaricom shares had gone all the way to 45 shillings, if it's now trading at a much lower price than that, I believe that at some point it is going to trend back upwards. So I'll buy just based on the technical analysis, knowing that it's going to go up, and then just looking at the trends and the companies that I like. So there is also, as you go to the next slide, there is also a company. Okay, yeah, sorry, you're being advised also on Dovo, which is also regulated by the Capital Markets Authority. So what is the difference between fair share price, book value price, and market share price? So the market share price is the market price. That's why when you go to the market, that is what you're going to buy. This is what you're going to buy the share price at. Then what is fair share price is, what analysts do is they will project the performance of the company over the next 5 years and then assume that they will grow at a certain level over the long term. And then they will bring the present value of all that share today and say, if all factors remain constant, this is the price that you need to be paying for this price, for this share. And that is what the fair share price is. So you use that to compare with the market share. So if, for example, the fair price is actually lower, then you buy because you expect it to go up. If it's high, then you sell because you expect it to trade lower, because we believe that all of us are logical investors, and that is where the market arbitrage comes in. In terms of book value price, you take the net asset value. So you look at all the assets that a company owns, and then you divide by the share, and that becomes the book value of that particular company. So hope that is clear. So I want us, in terms of just a quick practice, so that we can be able to see how are we able to make these decisions. If you look at which bank would you invest in, there are 3 banks that we have here. You are an investment analyst advising a young professional who wants to invest 100,000 in a Kenyan bank listed on the NSE. Their goal is to hold the shares for about 3 to 5 years with a focus on stable growth and good dividends. You must compare Equity Group, KCB, and ABSA using the various metrics given. So what do? You have Equity Bank there. Their last revenue for the last financial year, that is in 2024, they made a revenue of 149 billion. We have KCB, whose revenue was 118, and we have ABSA, whose revenue was 51 B. So the net profit for each of these companies is as shown there: 46 billion for Equity, 34 billion for KCB, and 15 billion for ABSA. So the earnings per share, remember we said that the net profit divided by the total number of outstanding shares. The earnings per share is 11 shillings for Equity, 9.2 for KCB, and 8.3 for ABSA. So if you look at that, for each unit of earning, you are actually paying 6.8 shillings for Equity, 7.9 shillings for KCB, and 5.8 shillings for ABSA. The price to book, so that is the book value that I've explained, is that for each shilling of the book value, so you actually pay 1.1 for Equity, 0.9 for KCB, and 1.2 for ABSA. If you look at the dividends, you're getting a 9% dividend yield for ABSA, about for KCB 8.2, and dividend yield for equity is 7.5. So in totality, what are you getting in terms of return? KCB equity gives you the best return of 25%, KCB at 21, and ABSA at 22. So if you look at the non-performing loans for each of these banks, about equity is 7.5, KCB is at 10.4, and then 6.3 for ABSA. And if you look at generally what the market is thinking about all this is that equity is looked at as a strong digital and regional growth. Then KCB, the key thing is restructuring post DRC write-offs. That's what they are focusing on. And then ABSA is looking at a steady low risk performance. So if you look at all these metrics, you can actually ask yourself, which company should I be investing in? So those are the things that the analysts wake up to look at. And I would just like us to look at the questions so that we are able to answer this each one by one, so that we can actually make an informed decision. So Mantu, you can go to the next slide. So if you look at each of these ratios, you look at which bank appears undervalued based on a price to earnings book ratio and a PE and a price to book ratio. If you go back, Mantu, sorry, we shall keep shuffling between the two. If you look at the price to earnings ratio, this is the unit, how much are you paying for each unit of earning? So the lower the price to earnings ratio, the better it is for you. So on that basis alone, you will actually see that it is better to buy ABSA. It is cheaper, followed by equity, followed by KCB. If you look at a price to book ratio, price to book ratio again, you actually see that KCB is cheaper because you're paying for each unit of earnings, for each unit of the book, you're actually paying a discount, a 10% discount. ABSA is more expensive, Equity Bank is in the middle. If you look at, so that is on those ratios. If you look at who gives the best income based on dividends, so if you are a dividend player, then you need to look at the dividend yield, and there ABSA quite stands out. If you are to look at which company is growing the most strongly, if you look at growth, again, you will actually see that I think we didn't have the growth year-on-year, but if you look at the return on equity there, you'll actually see that Equity Bank is giving you a better return on your equity compared to KCB and also to ABSA. So what are the risks with each? Again, down there, which fits moderate growth income investor. So if you look at these two, the ones, which one really, for someone who doesn't want to take a lot of risk, they just look at moderate growth and a good dividend, then you can actually say that is ABSA. If you're looking for significant growth, then you can actually see that Equity Bank is where you need to be. So actually we can go to, that is how you actually make these decisions as you look at the various companies. So we can go to the next slide, Mantui. So if, for example, you're looking for growth plus digital investor, ideal for, so Equity Bank, you're looking at growth plus digital investor, someone who wants a lot of digital growth that is led by digital. So strong earnings, visionary leadership, expanding into DRC. KCB is really value due to the low price to book value and the moderate high to dividend yield. But the NPL someone needs to look at the NPLs because it's the highest among the three that we are looking at. Then we have ABSA, which is really a dividend play. So this is how you determine which ones to grow. What do we do as analysts? So as analysts, we would come up with what is called a blended review, so that we are able to come up with a fair price of all this. And then we will look at which company has a higher, from where it is trading today and where it's going to, we expect it to go. Then we determine how we are going to invest. So in summary, when you look at how do we invest them, we can go to the next slide, Mantui. How do we check which one is a good investment and reward? So you can actually see that in terms of growth potential, when a company is doing really well in terms of growth, then it means that it's a higher risk, because if it gets one thing wrong, it becomes a big challenge. But you can actually see some companies like Equity again have grown significantly over a period of time. You look at the valuation, and valuation is really relative to historical and also competitor in the same industry. That way, you can actually be able to see which one is trading at a lower price to book and all that. Then dividends, if you are an income stock investor, you look at the ones with the higher dividend yield. Then in terms of NPF, they affect your the amount of money that is going to come to you. So a company that is able to manage their risk, and in this case, in the banking sector, is the non-performing loan, then the lower the NPL, the better. And definitely remember, as an investor, you are looking at a best return, which is in form of return ROE. So one of the things that I need us to talk about even before we close on this is that a good company does not necessarily mean it's a good stock. You can have a very good company, but the stock is not great because of the valuation. It's overpriced. So a good company, not a good stock, but in most cases, a good company gives you a good stock if it's priced well. So that is all about equity investment. I think you can always be able to take more conversations about that. I want to look at the questions on the chat. What are some of the investment options, example of companies that prioritize dividends, as you mentioned in the preference shares, or is not explicit as from the table? It is not very explicit from the table. What I'll do, Colin, if you have access to the business daily, you can actually be able to see the companies that have better and have very high dividends. So I'll give you an example of BAT. Their dividend is about 11%. If you go to the banking sector, I want to go to the banking sector. Some of the ones with the highest dividend yield is Stanchart. So you can actually, the information is readily available and it's on the business daily, so you should be able to get that. So and remember, the reason why I'm not giving an outright answer is because they vary from year to year, depending on how the company has been doing. What are some of the qualities of a good share? I think a good share is one that has significant upside, and the fundamentals of the organization that you're investing in is actually, they're actually sound. If, for example, you're investing in a company that has a very fluid fundamentals, despite the fact that it is cheap, it could actually not be a good stock. How much can one start with? I think you can actually invest. Right now, I don't know whether the regulations have been fully gazetted, but we are getting to a point where you can actually do what is called fractional shares. Initially, you could do a minimum of 100 shares. But that was the regulations. And I think right now, with the fractionalization, you could actually trade much lower than that. What about the agricultural companies? Most of the agricultural companies are very closely held, and the trading becomes very illiquid. So it is something that you need to look out for, even if you get there. And some of these companies, if you don't get significant shareholding, you might not be able to make a lot of say. Patrick is asking, making a diversified portfolio versus an index stock. So if, for example, we had very good index companies or a good index that you can actually buy into, my recommendation is, if you're not an active investor, someone who does this for a living, then you could easily be able, you should actually consider just buying you should actually consider just buying the index. But in this country, I don't think there are people who sell the index. So that becomes a big challenge. So the question is, how then, what is the alternative? We shall shortly be going into conversation on, we shall be going into a conversation on collective investment schemes. And when you look at that, that is the alternative of investment. So you can actually decide that I'm going to invest directly through, that's what we have gone through right now. But also you can actually now go through fund managers. I suggest you go to the next topic and then we answer all the questions at the end. If that is okay with you, Mantui, we can just jump to the next one, because I know we have a couple of other slides to go through. Some of the other things that maybe we could do is just the questions, we shall send answers to them. So I wanted to jump into, okay, yeah. So we can do quickly introduction to collective investment schemes. So I'm sure most of us have been hearing about money market fund. Can I invest in a money market fund? Should I invest in a money market fund? All those questions. So the question is, what are these? These are, when you hear money market fund, they are part of an asset class that is called collective investment schemes, where different investors come together through a fund manager, and the money that is put together is invested by the fund manager, and the distribution of income is done at the end. So some of them would be so the underlying assets, depending on the underlying assets, then they get their name. So if it's an equity fund, like what I was talking about, like instead of investing in one by one share, you can actually look at the fund manager that you want to invest in, and you invest in equities in an equity fund. So that is what is called a pooled fund. So what are some of the key players when it comes to collective investment schemes? We have the investors, who are the people who are bringing in their money. And then we have the fund manager, who decides where the money is going to be invested. They take all the investment decisions. We have the regulator, who oversees the running of the schemes, just to provide sanity and make sure that people understand what they're investing in. They have regulations that they have provided. We have the custodian, who holds the money on behalf of the investors. Remember, the fund manager, the money will not be in the accounts of the fund manager. Then we have the trustee. This is the person who speaks on your behalf. They're the ones who stand in to make the right decisions. And all these are looking after the investment portfolio. So again, as we speak, there are a couple of investment pooled funds in the market, and all of them are actually they're actually required by law to make sure that they publish their results on a day-to-day basis in at least 2 daily newspapers of nationwide circulation. So next slide. So in terms of, I've talked about the next slide, which is really the governance structure. You have the members, you have the fund manager making decisions, the trustees overseeing, and then the custodian, and who wraps it all is the regulator. You can go to the next slide. So I've given the roles of each. Again, we can, and the reason why this is very important, because one of the questions that people ask, how safe is my money with XYZ fund manager? The answer is the regulator has provided a framework such that it is not easy for the fund manager to actually make decisions that are against what the formative documents are. And the formative documents are created based on the regulations. I'll give you an example. The regulator says that you cannot invest more than 25% of a certain fund in one investment. So that helps in terms of diversification. So the fund manager is again taken, their actions are reviewed by the trustee. So the trustee is the person who legally owns the fund. So they look at what the fund manager is doing, and then the custodian. So if there is anything that needs to be, that is fishy, the three or four players actually come in to just bubble up whether there is an issue. So we can go to the next one. So what are some of the key collective investment schemes that you'll hear about? I've talked about the equity funds. These invest likely in the NSE, and that is not to say 100% will be in the NSE. Maybe 80% will be in the NSE, because remember, these are very liquid assets. So it means that at any one time when you need your money, you should be able to get it. So about 80% will be in the NSE shares. We have balanced funds. The balanced fund will invest some in the stock market, some in the bonds, some in cash. So relatively mixed risk sort of portfolio. We have fixed income funds. Fixed income funds invest in what we went through last time. We invest in government securities, fixed deposits, corporate bonds, but they're largely focused on government investment, on bond investment. Then we have the real estate investment trust. So the real estate investment trust, the underlying asset is the real estate. I'm sure most of us have heard of Kwetu. That is one of the good examples of a real estate investment trust. You can actually buy small units within that. Then we have the special funds. For the special funds, they are allowed to invest up to 80% in a specific way. So you'll see some of them really investing maybe offshore. You'll see some of them just investing in real estate as well. Just special funds. The key aim is really capital preservation and growth. And then we have the money market funds. We have seen significant growth in money market funds, relatively liquid, and you're able to get your money on the go. So again, depending on what you want to do and the risk you want to undertake, then you can decide which investment underlying assets to actually take. And remember, we have gone through most of these asset classes. So I kind of understand the risk that you are going to undertake. So for equity fund, you'll definitely get volatility because they're investing in the same stock market that you have gone through. For money market, you don't expect out of volatility. And then for fixed income funds, you expect stability, and you can actually all of them should be able to get your money on the go. So in terms of risk return, equity funds, the return is relatively high, risk is high, and then the investor suitability is for long-term investors. For special funds, again, experienced investors are the ones who should go there because you are asking the hard questions, and that's why you'll see that for special funds, most of the time the investment amount will be higher, maybe 100,000, 1 million for some of them. For real estate investment trust, again, they are sophisticated investors and the minimums are pretty high. For balanced funds, again, growth and income, and the risk is medium. For fixed income, the risk is also low and liquidity is relatively high again. If you're looking at investing of anything between 2 to 5 years, Sharia compliant is really Islamic ethical investors, and then money market fund, the risk is low and you should be able to get your money on an ongoing basis. I think for most of them now, you can actually be able to get your money instantly, like just it's your wallet sort of investment. Yeah. So what are the benefits of investing in a CIS as opposed to individual stocks or investments? One of them is diversification. Money market funds invest in a variety of securities, so you're able to get that. Then the other thing, you get free management, professional management. Remember, once you invest in these funds, you'll be getting your statements plus what is called a fact sheet, and it will have the market commentary. So you are able to get a lot of information even as you grow. Then there is lower end, the other thing is about, you can actually, for some of the money market funds, there's low as 1,000. So you can actually start getting conversant with the capital markets by just investing in CISs, and then liquidity, you get your money very easily. So those are some of the reasons why you can invest in a CIS. So the key question is, you need to decide which fund manager to invest in. Again, how do you decide that? It's really the brand you care for, the level of technology that they have employed and the returns that they are getting, and then the risk that they are taking. So those are some of the things that you need to look at. So Mantui, I don't know why we take a pause and can finish with real estate.
Yeah, I think we can take a 10-minute break at this point, and then resume after the break. Okay, great. Well, ladies and gentlemen, we'll take a short break, and then resume in 10 minutes. All right, welcome back, ladies and gentlemen. We were on a short break and now we resume with the training on real estate investment. Karibu sana Liza.
Thank you, Mantui. I was trying to answer as many questions during the break as much as possible. We shall continue towards the end. So, and it will be good that we continue getting reactions in the group, in the chat and questions, so that we can try as much as possible to answer your questions as we go. And then the ones who have put the questions on the Q&A, please just feel free again to look at the answers. We have done at least 60% of the questions that are there. So I would like us to think about real estate. I'm sure most of us have interacted with real estate, and I would just like us to, just as just self-reflection. And I'm looking at the charts. When you have, if you have any relation with whatever I'm talking about, just put an emoji or whatever. So the first one is, which of these is most relatable to you and what happened? You have an unbuilt plot. So you or someone you know bought a plot but never built on it, or have not started building on it. I'm looking at, yes, Buroti Jane, that is one of us. Farming on land, you visited your land and found someone else farming on it. How many of us have gone and they found the neighbor is the one farming on their land? Anyone? That is one of us. Yes, you have a remote plot. Your plot is so far that even Google Maps cannot locate it. I know you bought somewhere, but yes, it remains as remote and you don't even have the entry. Or some of us, missing deed. You honestly can't remember where your title deed is. truly, when you are asked, okay, why is that title? You're like, hey, did I collect it? Is it at home? Is it in shares? Or the SACCO purchase, you have bought land through a SACCO or a chama. The chama that you work with, or the one. So it's good to know that at times we own land, but we not necessarily use it. What does that mean? Why is that relevant? It's relevant because the land itself could not be working for us. So let's do this. I would like to give you an assignment. Real estate is, yes, we always told real estate you never lose value, but I would also want to ask that, can we be able to have real estate that is producing results? Yeah. So that is what I wanted us to, it's very important for us to think about whether we have real estate that is producing results and what we can do that can help us actually get the results that we bought the land for. So the next slide, Mantui, please. So when you're thinking about real estate, why did you buy the land? There are a couple of reasons why we bought the land we bought. Some of them are, I bought because I was told the railway is going to pass through here. And if the railway passes through here, I'm definitely going to get a capital appreciation. Maybe those are the ones that are remote and we are still thinking whether the railway is coming or not. So infrastructure, that is what we had been told. The other reason that we buy is because we want to develop and sell the land. Yes, we are speculators. So that is part of the reasons why we buy. Then the other one is because I want to construct. So I want to make sure that by the time I retire, at least I have a job to go speak to the tenants, or just a good real estate income. Remember, the real estate income also can be pretty decent. Then earning for a return. So ultimate goal is really to get a return. So the question I would like to ask you is, are you still getting the return that you asked you got into that real estate for? So it is very good to keep asking ourselves whether the reason why we got into this real estate is still serving us. So there are different reasons we buy into real estate. We could just be buying into raw land and develop for future development because we believe that we can do a good development on it. Maybe we want to do agriculture. Remember, we still need a lot of food. So that is a good venture that someone can look into. We are looking at commercial buildings. So how do we get land for maybe the apartments or the or even the malls that you want to do, and then just residential. I want to live in a nice place. So when you're thinking about real estate, please have the end in mind. How will the money come back? So the three things that we always look at when you're looking at investment is the risk, return, and liquidity. How money gets back to your pocket. That is very, very important. So we can go to the next slide. So some of the reasons why we hold on to real estate investments, they range from very practical to very emotional. Some of the emotional conversations would be like, people will never sell land. It is a sign of what? It's a sign of like you're calling poverty when you sell land. So those are some of the emotional issues. So some of the other reasons why some practical reasons is really we want a tangible asset that we can use to as something that can help us in terms of growth of our income and what we are doing. Some of them we just buy because it's a good deal. Someone is really maybe distressed and we want to buy into that. So easy to understand and minimal market knowledge, so that is very easy. Then historically, we have been told that real estate does not lose value. So that is the main reason why we are getting into this real estate, because we are looking at growth in the long term. So we need to just be sure whether those myths are still okay. And then the other issue, most people actually don't invest in others, the stock market, they don't invest in bonds because it's not something tangible. So they do not have faith in the alternative investments. And then some of the others really just cultural value. And those are some of the reasons that people invest in real estate. So when we are thinking about real estate, what are some of the strategies that we can actually look at? One of them is clarify the goals. Why am I getting into this? Is it because I want passive income? Is it because, yes, because of passive income, is this the best passive income that I can get? Is it part of retirement planning, or I just want security? The other one that we need to look at, so clarify the goal at first, then look at the return on investment. And when you think about return on investment, let us look at it in two ways. One, what is the return itself, and what is the cash flow that is coming into it. So for example, if I'm taking a loan to do investments in real estate, the question is, once done and the moratorium is lifted, am I able to comfortably pay for that loan using that investment that I have undertaken? The other one is really, when you think about it, is about tax and strategy flexibility, especially when you're doing legacy planning. I want to make sure that my kids have money that they can use into a long term. So how do I put that into their trusts? That is very important. Then the other thing is about time horizon. How long do I want to do this? And how do I exit even when the time comes? And then finally, how easy is it to get how is it for me to get loans or funding around it? So remember, the beauty about real estate is that at least it can be mortgaged, and you can actually be able to get some sort of capital through it. So you start with the end in mind. Why am I getting into this particular investment? And if I get into this investment, how eventually will I be able to get out? So the other big conversation that we have, and I know I'm really rushing because we need to have a conversation towards the end. So the other question that we always have when it comes to real estate, we can go to the next slide. Do I buy a house, or do I mortgage, or should I stay where I am? So some of the key considerations that we need to look at is one, cash flow versus comfort. How do those two coexist? Some of us, it is very important for us to live in our own house, and so we don't mind really going very far. For some of us, comfort is important. So maybe we do not want to drive very fast. So you need to understand what works for you. So is it, are you looking at the comfort, or how does the world look like? So prioritize, and when you're looking at also getting a mortgage, the question is, can I comfortably service this loan? So the cash flow is important. And when you're doing an investment on real estate, it is good that the rental income is sufficient to actually take care of the loan that you're paying. So the other thing is about affordability. Can I manage the long-term financial commitment of home ownership? Remember, you are taking a mortgage today that maybe you're going to pay for 15 years. So how easy is that? And how would the world look like if for example, if you lost your job or something like that? So think about those things as you take into a real estate investment. Then the other one is rental income versus saving rent. So some of us look at in terms of rental income, if, for example, I have a house, let's say, for example, in Thika, and I am living in Kilimani. So the question is it better off for me to go move to Thika and then be waking up early, or how does the world look like? So just always think about those things, because at times you could be getting a higher return and you are able to pay rent. So some of these things are really personal, and you need to think about them. Then the long-term stay, do I plan to stay in one place, or at least in the next at least 5 to 7 years? So if, for example, I'm buying an apartment today, do I see myself staying there, or I'm building this place? Do I see myself growing old there? And what is the world that I'm creating around myself for me to be able to work on that? Then the other key question that we always don't ask ourselves, maybe, is the landlord role. Are you willing to be the one chasing the rent from various people? And if not, what is the help that you're going to get? So ask all these questions, because remember, if you have maybe a very significantly involving job, and you have done maybe, for example, apartments, who is going to manage them for you? That is very important. And also, when it comes also to buying your home, really think about is that a place that you want to live for the long term? And if you wanted to exit, how easy is it for you to exit? So what are some of the exit strategies for real estate? Because remember, we said that you start with the end in mind. So for urban apartments, you always need to think about it when can I be able to exit this? And especially as part of estate planning. If your kids are not going to come and live in those apartments where you have today, how are you going to exit that? When you think about remote land and poor infrastructure, how will the demand look like, and what is going to lead investment and growth in that particular market? Then remember, when you think about urban land, you're looking at the good infrastructure. The key is not to buy when the infrastructure is there. It's to buy when the infrastructure is almost like guaranteed that it's coming, so that you buy slightly lower. And this likely comes in even when you're thinking about off-plan purchases. Just make sure that you're doing the off-plan purchases with the right people, and also in the right locations. And then Finally, when it comes to apartments, why are you buying that apartment today? So when you think about real estate, the key things that you need to think about is, again, one, the return that you're going to get, the risk that you're getting into. The location is key. In real estate, you lose money before you actually even invest in it. So it is important to think about that. And if you're not ready to get into real estate development yourself, is there an opportunity to invest through unit real estate investment trusts? Because that is another way to get that exposure. So, Matthew, I want to pause and give it back to you so I can take questions.
All right, great. Allow me to just stop sharing so that I'm also able to see some of the questions.
Yes.
All right. Okay, so thank you so much, Elizabeth, for a very insightful first and second part of the questions. I hope our participants, I can see a bit of engagement. So maybe we can now go to questions on the chat. And then also, if you would want to raise your hand, please do so that we can hear your questions. Right. So we have Isaac, who says, and I think you've touched on this a bit, but what key information should I be looking for in a company's financial statements to help decide whether to buy its stock or not? And then George asks, what should one look out for if you're investing for long-term capital gains instead of dividends? As a Kenyan, can I be able to invest in other markets as an individual in Tanzania?
Yeah. Okay. So on the first one, what information should I be looking at in the company's financial statements? The key thing is looking at you look at the profit and loss and see if the company is making money and what are the future prospects of that company. If, for example, you would be thinking about a company whose sector is going to struggle, then you need to rethink about it. I would say maybe something like what are the things that are happening in the media sector? How are those companies, I'm just using that as an example, how is the digital space affecting maybe the revenues of the previous media companies? So you need to ask yourself this revenue, but how sustainable is it? That's number one. And then number two, you go to the balance sheet and look at how much leverage maybe this company is how much leverage, how much debt they have, and that will help you in making that decision. The key issue is really looking at it over a period of time so that you can be able to, if you look at it over a period of time, you'll be able to, you can easily be able to see whether this company is headed in the right direction. So there was a question on whether you can buy outside the country. Yes, East African citizens actually can trade across. But I think you need to open a CDS account there. There is a time there was an integration, but that has not completed in terms of integration between the two. What document does one get? Sorry, no, Mantua can continue. Someone is saying, please share. I don't know what that is.
And also maybe just to mention, the slides and recordings usually come via Zoom. And so once you've registered, you should be able to get the slides and recordings the next day. Please do check your junk folder. And in case, if still you're not able to get them, you can reach out to the email address I'm sharing just now on the chat. Yes, you can reach out on email and we'll be able to assist you. So that I think should address all the questions on the slides. Then Martha asks, what document does one get once they buy apartments? Like, for example, land, you get a title deed. What about apartments? Yeah.
You get a list document. That list document is like a rider on the mother list. So you're part of them. You're part of, what do I call it? You're part of the owners. It's again like a commingled land, but you get what is called a list document, which is the same value as a title deed.
Great. I see Caleb asking if we offer CDS services. We do have a custodial business unit, so you can visit any of our branches or reach out to our contact center and you will be supported on your investment journey. Then we have Jane asking, how does real estate equity compare with owning your own rental units? What is the return on investment?
So It depends with where you're investing, but and how you've done it. But in most cases, the yield that you get for all would average between 6 and 10%. That is the rental yield that you're going to get in both. So the only difference is that you will not be the one who would be doing the rent collection. You'll just be getting your own, you'll be getting that credited to your account. So that is the main difference.
Great. Then we have a question on NFTs, what they are and how to invest in them. And then Ida says, I have shares in different companies, but for some years now, I haven't been receiving dividends. I tried reaching out to my stockbroker, but so far they have been very unhelpful. Seeing as I don't live in the country, how can I go about finding out what is wrong? So this is also an interesting take on people in the diaspora and how they can manage investments in the country.
Okay. So we can start with an NFT. Is that those are non-fungible? They're like, sorry, they are not directly like shares. They are like blockchain. So what you basically happen is that you would be able to trade some of them, but in this market, not yet. What we are actually seeing is regulations that is coming up on blockchain and what can be done with them. Is it something that you would want to invest in? The answer is maybe, but I would suggest that one takes time to actually understand, and it could be part of the conversation that we'll have in the next session in terms of what are the other alternative investment options that one can look at buying. But as it is right now, it's not easily, you cannot go to any broker and buy them, but the regulations are coming up in terms of how those can be traded going forward. So the other ones in terms of questions on your shares, I think you could do an email to CDSC, because CDSC is a different company, and maybe copy your broker, because you should be able to get your information as easy as possible. It's something that we'll be happy to help.
Great. Thank you, Liz. Now, Samson is asking, is it safe to follow news that a certain politician or someone influential bought shares in a certain company, then you also buy from the same company?
The answer is no. You need to do your own analysis, because maybe they are just, and I'm not talking about politicians, it could be anyone. You need to do your own analysis. Remember what you said is that you should be able to understand the company so that when you buy that stock, you'll be able to hold on to it for the next 10 years. So the tips would be there, but it's good to do your analysis to see whether it's a company that you care for.
Thank you. And I think one thing I appreciate about today's training is that we've been given the tools to be able to, even if, at a high level, analyze some of these options and be able to make a more informed decision, so that even when you're dealing with a broker, you have some understanding of the process. So it's good, like you said, Liz, that we don't just follow people that we maybe even hold in high regard. We need to also do our own due diligence. Then we have a question from an anonymous attendee. Can a foreigner with an alien ID participate in these investments? And then
the answer is yes. Anyone is open to invest in the stock market.
Great. And then I think this one has also been addressed. Are there any apps that could be used to track changes in the market?
Are there any applications?
Yes.
Actually, you can let me just tell Zurich. You can actually log into Zurich's prosperity dashboard, and you'll be able to track all the changes in the stock market. We do it on real time. But yes, even the newspapers, you can be able to do that. There are quite a number of ways to get that information. If you work with a certain stockbroker, most of them actually provide the information very easily.
Great. Thank you. I think that's actually all the questions, unless there are any participants who might want to raise their hands and address their questions, address the questions themselves. Thank you so much, Liz. And maybe you can now give your closing remarks, just that touches on people who are beginning this journey, or some that have already been on it. How should they proceed, and what is the one thing they should take away from equities and rates and all these different investment options?
So if I'm a beginner today, I would start with a collective investment scheme so that I can understand the performance of the market and I'm able to ask the right questions. Again, if you don't have a lot of time, that is the best place to start. Again, reason being, you cannot analyze the there are over 60 companies that are listed in the stock exchange and be able to make the right call. So you need to start somewhere. And my natural recommendation would be to start with a collective investment scheme. If you want to understand equities, you could actually start with an equity fund. How do you determine which one to start with? Again, the information is readily available. Us as Zurich will also be able to unfold you into that process, whereby you decide where to go. If you have gotten to a point whereby you want now to invest in the stock market, again, the conversation ought to be, which sector do I care for and how do I think it's going to do well? And this is largely determined by how the economy is doing. So in a good market whereby the stock market, the economy is doing well, again, financial sector always stands out, technology always stands out. And again, some of these companies, you just look at the historical performance of how this has been, and you'll be able to make that decision. What is the other way that you can actually be able to understand these investments? I'm sure most of us, with the changes in the NSSF, we are maybe members of pension scheme. Just attending some of those AGMs and also asking questions would be key. So my thing is get as much information. Let us not dismiss investments, but at the same time, let us not jump into investments that we do not understand. When it comes to things like real estate, please the end in mind. It does not matter who is selling real estate. Just make sure that you take your time to actually know how will I be able to make money out of this? How would I exit this and how money will come to my account? So that is very, very important. And then now, very important thing lately is thinking about how this will be distributed to your dependents. So even as you invest in the stock market, who knows about it? Who can be able to, how is it being held? So that you do not let your money go unattended. The reason why I say that, if you look at the amount of unclaimed financial assets, we are over 84 billion now. So a lot of dividend, and most of it would really be dividend investments where people did not tell their people that they actually had invested in some of these companies. So let's just make sure that we kind of put our financial world in order and think about how the distribution of this will be there when you are there or when you're not there. So I think that for me will be the key takeouts for now, even before I give my Zurich recommendation.
Thank you so much, Liz. And for me, one key takeaway, I mean, it's been a great session. The quote that you said on shares that Warren Buffett recommends that if you're not investing for like 10 years, do not even go ahead. And even as I share this in the chat, you could share what was the key takeaway for you. And I remember also when we did have our head of custodial business earlier in the year is that he shared that, wealth is a journey and it takes time. And this speaks to our need for instant gratification in this day and age. So I think, like you said, it's a journey. And when you're informed, it makes the journey better. I can see I think Shemin has shared very insightful info today. I will look out to begin with small investments to assist my future. Thank you. Thank you so much. And you've touched on your dependents. That is module 4 we will be having next week, planning for retirement. So a really nice way to get into retirement. Now you have an idea of how to go about your investments. And then now we're looking at legacy and how to make sure you've set up the next generation in a good way. So we will be having planning for retirement next week. We look forward to having all of you. And Arjun has said, very informative session, now to execute. Yes, that's where it always is, the work. The work begins. You can learn so much, but if nothing happens, nothing happens. So thank you so much, Liz. Thank you so much, Victor, for the sign language interpretation together with Faith. This has been great. And thank you so much, participants, even for your patience when we had a bit of the technical challenges. I think we have a great community here, and for your participation and attention throughout. So we look forward to having you next week. We'll be having our second last session. And as always, give us feedback. Let's engage. Let's make this better and better.
And Mantri, maybe I could just request the people here, please just go to our website, and we would like to get insights in terms of how you are using the app, the tools, to actually make your life easier. We have said it's execution. You cannot execute if you have no support system. So we'd really like to be your support system. So if you could just go to our website, go to the Prosperity Dashboard, and you will be able to start your wealth creation journey. We will be happy to handhold you through the investment process, because that is what this is the impact that we will be able to create. So if you go to our website is www.zurichconsulting.com. You would be able to get those. I could share the link in the WhatsApp group. You can always reach out to me on my number is 0728 600 576. I will be able to guide you to the right person to go to. Or you can follow me on my socials. Pretty active when it comes to investment matters. So thank you so much and have a blessed one.
Okay, thank you. Thank you so much, Elizabeth. Thank you, everybody. See you next week, same time, same place. Goodbye.